Hi, folks. In my long career of nearly 30 years now, what I've seen is that most investors are struggling in sort of a tug of war when they come to invest in the markets. And while we'll talk about this more in the video, I want to emphasize that investing need not be a tug of war. Investing need not be struggling to, you know, get any specific success out of it. Do read the disclaimer fully and understand it before we go forward in the video. So, as I was mentioning, the usual questions in mind are basically where should I invest within equities? So, now that you have been confident of coming to the equity markets, specifically for new investors, and within the equity markets, where should I be investing? And primarily, we are categorized into three major segments in the market: the large caps, which is the top 100 stocks; the mid caps, which is the next 150 stocks; and the small caps, which are stocks over and above the 250 stocks that we already talked about. So there are these options where to invest here. Now, traditionally and more safely, most people would recommend large caps stocks. They are in the comfort zone. Uh, Significant number of folks will say, "I choose large cap for safety. They are stable. They are the blue chips. They fall less when the markets correct." And these are very reassuring sort of one would say characteristics of large cap names. However, when the markets fall, you will observe even large caps fall very, very aggressively. So in 2008, when we had the GFC, large caps fell almost 61% during that phase. In November 10 to December 11 period, large caps fell again nearly 30%. In COVID times, large caps were down again 30%. In October 21 to June 22 period, large cap index was down on nearly 18%. In September to 25 March, September 24, we were down again 17%. So there have been instances where even large cap names really take a dive, and that is not very comforting. So the large cap names and everything is very comforting, no doubt about it. But when the market surges, so when the market, really is in a bull cycle, so the mid caps and the small caps start to fly, and then the large cap name owners uh, get the FOMO. So while they very well know that during bull runs, mid and small caps are going to fly very hard, but when the time really comes, the FOMO sets in that I'm sitting with large caps and they're giving me 12%, 13% kind of annualized return. But look at these mid and small caps, and the party talk starts about mid and small caps. So then you can see various periods recently, April 23 to September 24, large caps up 62%, small caps up 122%. April 20 to October 21, large caps up 135%, mid and small caps up 200 to 250%. March 09 to November 10, large caps up 160%, mid and small cap up 240%. So the lower cap segment, the mid and small cap temptation is always there to give that additional alpha to the portfolio. So during bull markets, investors feel very excited about the lower caps. And during bear markets, investors start to feel FOMO of not having invested in large caps where the correction is lower. So, there is a give and take happening at all the time. There are times when you want to be in small cap, there are times when you want to be in large caps space. So adding to all this confusion, most folks don't even make any profits in lower caps. So if we see this small cap chart of the last decade and a half, you'll see that for many years, small cap investors did not make any money. There are sporadic and very sharp runs when they happen, but over a longer period of time, the CAGR is not really that fancy there. The second dilemma that most investors face is when will the next big market shock come? When will be the next chaos, the next war, the next maybe some terrorist attack, perhaps some diktat or tariff war kind of a situation. So anything can come and strike the market where all the calculations of your regular investing will go haywire, because there is an external shock to the system, and the system will take time to stabilize and get back to its normal path. So in that scenario, how to protect and configure your portfolio. So as I mentioned, markets can really turn in a heartbeat. A banking crisis can happen, global pandemic can happen, surprise rate hikes can happen, geopolitical crisis can happen, and the world is also moving at a very very fast pace. It is actually going exponential. If you see the average life of a company in S&P 500, for instance, is going down dramatically because there is so much of not just technology change that is coming through, but the market share, the leadership in the market, everything is changing. Customer preferences is it's just a very very fast paced world. uh, and could be because of social media. Panic also spreads very very quickly these days, and the swings are also wild. The portfolio swings can happen really wild. So having a hedge is no longer an option. Basically, uh, while we create all our assets in terms of trying to project growth, trying to project earnings, perhaps, or trying to follow some momentum investing strategy, we really also need to think about protecting that. It's sort of like an insurance, a hedge. And through history, one asset has stood very tall during crisis, and that obviously is gold. If we see versus the market's performance, let's say the GFC, January 8 to March '09, you can see all in market indices down 50 to 70%, gold is up 38%. November 10 to December 11 crisis, all indices down 28 to 40%, gold is up 42%. Then if we see longer periods of no returns, indices making no returns over 5 year periods, gold up 193%. More recently in COVID times, uh, markets recovering back after COVID, large caps 1%, mid caps 18% down, small caps 44% down, while gold up 80% in the same time period. And very recently, August 24 to Feb 25, you can see all indices down 13, 18, and 21%, while gold is up 24%. So there is this huge tug of war that is happening between you and your thought process, or your the ambiguities that you are uh, dealing with. And these are the core issues that we need to sort of get a handle on. So the countless questions and ambiguity the common investor has to go through. Will I always be one step behind the market? I mean, there are times where it becomes very frustrating, where you're doing so many things right, but then you always feel that the market is always one step ahead of me. Why does every choice feel like a trade-off between fear and greed? Is there a way to grow my wealth without losing any sleep? Is there a smarter way to stay invested across all market cycles? Must I keep shifting my money chasing the next winner? Can I avoid big drawdowns and still capture some opportunities? How do I prepare for the shocks that come without warning? Can I invest with confidence no matter what headlines scream? Can I basically invest in peace without worry? That is the key, search for balance that is happening inside us. Many of us, over a period of time, when we get that experience, are able to come to that perfect point of balance. And many of us perhaps keep searching for it, and stay disturbed due to that. So this is the culmination of uh, you know many investors experience that comes around, that don't chase just returns, don't chase just a certain particular type of stock. Be more holistic in your approach and search for balance. So the next question is there a simple way to remove ambiguity and create the ideal balance, so that investing can become a very peaceful, mindful, and a relaxing journey? The components of the ideal balance are segments that we have in the equity markets, different segments, different behavior in each segment, and we combine them together. So, keeping it simple, we need a balance of all three segments, because we really can't put a finger on how each of these are going to move, and also in relation with each other. And additionally, what about the hedge for the crisis time? You want to add gold to this. So, the components of the ideal balance become exposure to large caps, exposure to mid caps, exposure to small caps, and exposure to gold. And to make it further balanced, Let's say we have an exposure of 25% each to large caps, 25% to mid caps, 25% to small caps, and 25% to gold. And that would make the perfect uh, core, strong, long term portfolio for you. And on top of that, what if you could allocate and rebalance equally on a monthly basis? So you put allocation of 25% each, and then every month you rebalance the allocation, so that you are sort of taking the advantage of the winners and the losers also as they're moving along. Large caps moving up, mid and small caps stagnating. Money is gradually moving from large caps to mid caps and small caps while it is going up, and when the other one moves, money will get rebalanced. So a very nice rebalancing sort of a portfolio can be imagined if you look at it this way. Yes, this is not chasing the highest returns possible. That is not the idea. The idea is to have a very well balanced portfolio, which will give you a lot of peace of mind. So what will be the outcome of such a portfolio? That is the question. If we were to combine all this, what will the outcome be? And what if we can build a momentum strategy using the same logic? That is the matter in front of us right now. So we are doing a live webinar where we are launching something very special on 5th of July, Saturday at 11 a.m. There's a link in the description below. Please join us. I will be disclosing something very new and special on that day, and I'll be looking forward to seeing you that day. Thank you all, and see you on 5th of July at 11 a.m. Bye.